about 41,000. To discuss all this and more over the next hour, I'll be joined by Adam Shapiro, as well as Rick Newman and Dan Halley. Julie LaRoche also with us for the next few minutes. And I want to bring in David Zervos. He is Jefferies' chief market strategist. He's joining us from Florida. David, I do want to talk to you about equities, but I got to start with oil because of what we are seeing today. And I know when it comes to some equities, you're saying you want to buy the dip. Would you want to do that with oil right now or oil stocks, for example?
Well, first, let me be clear, Julie. We recommend buying equities only with a hedge, and the hedge is, for many years, our hedge has been in the interest rate markets, but with interest rates all at zero, we've had to kind of get more creative in the last 3 to 4 weeks. And what we've done is moved our hedge to the short end of the investment grade credit market. So what we do is we have a long position in short end investment grade credits, single A's and above, so nothing even triple B, which were at the time when we went back in yielding about 200 over treasuries. We leverage that up as our sort of risk parity hedge to a long equity position. So we're not naked long equities. We still think the Fed will pull levers in a downturn in the economy and a downturn in the markets, which would probably be somewhat synonymous with each other at this stage. And that lever, I think, is the only lever that you can really see them pulling that has a market impact is in these investment grade bonds, because they're done with treasuries at zero rates. The QE at the long end isn't really a viable hedge. And so we're looking at that as the way to play it. In terms of your question on oil, I'm not a commodity guy by training, and I do look at it from the global macro perspective. There's a lot better guys on the intricacies of the oil market, but this first contract just traded down to $10. I think the second contract's at 23, the third contract's at 26. So the oil market is basically saying, hey, look, we got a big storage problem. You guys, nobody's buying this stuff. Who knows? If it was a few more days in this contract, maybe it could even go, as my friend Pierre Anderon said, could go negative. And he's probably one of the best oil guys out there. So I think, you have to take this all with a grain of salt. The back month, futures, 1 year out, 2 year out, 3 year out, they're still showing $30 to $40 prices somewhere in that region out in 2022. So it's not a complete meltdown, but it is, look, that price, 30 to 40, is not going to sort of make a lot of people a lot of money, and certainly the Bakken or anything else. And we've seen bankruptcies accordingly down there. So it's still low, but I think this particular move today is much more of a specific move to the very front contract and the storage problems associated with a complete collapse in short-term demand.
Hey, David, it's Julia LaRoche. I want to come back into, what we know you for is watching the Fed, and you often talk about the Fed, and it's not what they should do, but what you think they might do next. We've seen so many moves in recent weeks. What do you think might be the next move for them, and how would that kind of play into the trade you were just referencing about the equities with the hedge tied to investment grade?
Well, I think the place that the Fed really has kind of left a bit high and dry here, and I want to leave the leveraged part of the corporate market out, because I think they are meaning to leave that part out. They're not going to go and take a company that's 8, 10, 12 times levered and give them a lot of help. They see those as probably institutions that flew a little too close to the sun, and they're probably not that interested in bailing out that kind of business model. But the residential mortgage market is really a place where there's been, in my opinion, a real lack of focus by the Fed. And it's a place where we've had pretty good lending standards compared to where we were 10 or 12 years ago. They fixed it. But the AAA pieces of non-agency residential mortgage bonds are still 200 plus over. You could say the same in commercial as well, although they did address that somewhat. But they're only focusing on the agency markets. And that really doesn't help very much the homeowner just by driving up secondary prices for mortgage pass-throughs. We saw this last time. It doesn't get a lower rate to the household. And the Fed is in there getting loans to small businesses. A guy owns 12 gas stations in Texas. He's getting a loan. A guy owns 12 restaurants in Kansas. He's getting a loan. And they're going into their banks and they're getting loans for these small businesses. But what about, the guy that's got a mortgage that's at 4, 5, 6%? still in good credit, still in good standing, has a job or is refocused and got a new job, and he's trying to get a lower rate or refinance his house with these new very low interest rates. And guess what? The bank's saying we're not interested. And that's really what the banks are saying, because the origination machine is largely broken. And there's a variety of reasons why that is, but the Fed could come in very easily and fix that. And I think their next step, my personal bet is their next step is something in the residential mortgage market. It's also going to play well for their image. Their image is trying to become more Main Street focused. And what better way to help Main Street than to sort of force through a refinancing of a bulk of mortgages. And remember, Julia, this is a big market. This is bigger than the corporate credit markets. It's bigger than the muni markets. It's a $10 trillion debt market that is primarily a Main Street market. It's not a Wall Street market. And I think focusing their stimulus efforts on buying secondary is just going to backfire like it did last time. And so my guess is they're looking at it, and I'm hopeful that they do something there, because I think it could be a lot of stimulus. You get 100 or 200 basis points lower on mortgage rates for people, whether it's short-term or long-term, however they 15-year, 30-year, or some sort of adjustable structure for a while. You can really help people out.
David, when you look at not only mortgage-backed securities, but let's expand this, though, to what's happening in commercial real estate, doesn't the Fed, though, face a double-edged sword? Because we had a guest on within the last 20 minutes who talked about their concern of disinflation. And with all of this refinancing and so many Americans having to sit on the sidelines, aren't we going to see a reset, not only in commercial real estate prices, but also in our homes, in residential real estate?
I think there's a real risk to that. There's no question that prices will be softened. That I'm a big believer in the disinflationary forces that were here before the virus, and I'm an even bigger believer in the disinflationary forces after, because I think the aggregate demand side is much more important long term for inflation than is the supply side, which could be temporarily inflationary. So I'm sympathetic to that view. But you're talking about a mortgage market which is either agency backed, so a large number of these are already backed by the government. I think 5 trillion, half the mortgage market. The other part is that the Fed could come in like it's done in the past and sort of backstop that AAA piece in the structured credit markets. This stuff is trading at 200 plus over. If you don't have a well-functioning AAA mortgage market or slice at the top of the structured product, there's no way new origination will take place. And that's where we sit today. The Fed is coming in and doing AAA CLOs. The Fed is backstopping, at least legacy at this stage, AAA CMBS. They're doing it in autos. They're doing it in dealer floor plans. They're doing it all throughout the South. Why are they not doing it for residential mortgages? I don't understand. It is mom and pop. So that's why my bet is they'll do it. It's trickier. It's a more complicated set of securities. I get it. And last time around, they didn't do it because things got better really quickly after they did a lot of other stuff. But I think that's what's coming, and it's likely to be quite helpful. And I don't think the agencies, Fannie and Freddie, or FHFA or FHA, can really do what the Fed can do with its balance sheet to help a refi wave. So that's the way I'm looking at it. I think that's next. I think that's pretty positive for some more stimulus to the households, and maybe less of a focus on this idea that the Fed's next going to buy equities. I think this idea that the Fed's going to set up an SPV to buy equities, they could do it. I'm not going to say they can't. They certainly could. That's going to just smell so much of bailout for Wall Street, leaving Main Street aside. So I just think they're going to be much more cognizant of that smell test with the American public. And they've done a good job so far with the Main Street funding facility. I think they just continue on it.
Hey, David, Rick Newman here. Can the Fed ever raise interest rates again? Not an entirely sarcastic question, basically just trying to say, do you foresee any time that the Fed can actually tighten monetary policy again?
I remember those questions in 2012 and 2011 and 2010, and we're never going to get out of this, and this is going to end. We're either going to be Japan or we're going to be Zimbabwe. And guess what? We raised rates. We raised rates almost 250 basis points, and then they went a little too far. They got a little sort of cocky with it, particularly Jay Powell back in Q4 of 2018, and they went a little too far, and they had to turn around and they cut 75 basis points last year. So I think the answer is absolutely yes, Rick. They'll definitely raise rates again. And the best sign that things are working and that people's expectations are that we are going back to some sense of normalcy will be a steepening of the curve and a selling off of the back end of the curve, the 10-year and 30-year yields. That'll be the sure sign that we're expecting some form of normalization/recovery. Without that, we're going to be very low rates at the long end are really going to signal that we're just Japan and we're not going to get out of it. So I think that will take time. I don't think the market's ready to price that in just yet. We have a lot more to learn about this virus that none of us know anything about in the field of finance. So we're a bit enslaved a little bit by the science and the epidemiology, which we don't know a lot about. But I feel pretty confident that we find some way forward that gets us back to a partial, if not full normalization, but maybe a different normal. Maybe we're not all going to the movie theaters. We're doing things more like we're doing them today, where we're going to a more virtual society. And maybe that's actually a very positive thing. It certainly fits with the technological views of disinflation as well. So I think the one underlying view is that there's a lot of disinflation. And the Fed is using that today, all of that disinflation that's been embedded in the system and the new disinflation to give us the windfall that allows them to do these programs, which are really cushioning the blow of this very, very nasty supply side shock.
Well, David, it's Julie again. Speaking of those programs, you put out this note, and I love this note. You're talking about some folks who are just kind of, losing their cool over one in particular, especially when it comes to the high yield ETF inclusion. Are they justified in their frustration when it comes to that?
Look, I mean, I can be, and I said in that piece, Julia, that I'm somewhat sympathetic, and I'm usually not very sympathetic to the kind of the sort of burn down the system hater mentality. And I do think a lot of those folks are really using this virus to sort of claim victory on a recession, which would have never happened had we not had this natural disaster. So I find that whole line of thinking of, this is the time to change the system and burn it down sort of thing is just a very repulsive thing for me. I don't buy it whatsoever. I think we were in a very good place coming into this. This is not about financial markets failing. This is about a real natural disaster. And there are ways to fix certain things, and you never want to let a good crisis go to waste, but this isn't a failure of finance or economics. It is just a tragedy. And a human tragedy. So I think the way we want to think about distributing the stimulus is a sort of a real decision on what's equitable in this time. And like I said, we're not really doing anything to help mom and pop get a lower loan on their $250,000 or $300,000 mortgage, but we are, basically giving funding to the levered loan space, for example, or the highly levered HYG structure, which happens to have, I think, still 5 or 6 companies in it which have declared bankruptcy, and they'll be moving out of the index, but they're still in there. So it just strikes me that these are equitable distribution debates that need to happen, and I can understand the frustration that many people have. And I personally, while I don't like to say what they should and shouldn't do, I like to comment on what I think they will do, because it's the only way we sort of generate alpha, is that I think there's probably a lot of politics that went into the Fed, including some of those more levered places in the corporate industry. And maybe that's coming from Congress and the administration, but very likely from Congress. And I think the Fed is probably much more suited and much more, what's the right word? It just fits the Fed mandate much more for them to start with the higher end of the capital structure and fix that and work its way down. And it's got plenty more of that high end capital structure to work with in places like the residential mortgage market before it needs to go in and buy high yield and equities. So I'm somewhat sympathetic to that. And look, I worry like everybody about the Fed's image. I was very worried about it post 2010 when I left the Fed, that they were going to get this stigma with Main Street versus Wall Street, and it really did stick. And I used to write a lot about it. I'm worried that they do it again. I think they're in a better, they have a better understanding internally of that now. So I'm happier about that. And that's why I project they will be more focused on Main Street in these programs that come. But, I do worry, my pedigree is, it's like my alumni. I started there in the early 90s. I went back in 09. You don't like to see the university that you came from or the alma mater that you came from, doing things that don't make a lot of sense or maybe reducing the credibility of the institution. So I do have that bias in me, and I think there's some risk to that as they go down into these into the nether reaches of the distressed lending area. It's just an area that's not really easy, I think, for one to explain why monetary policy and even monetary combined with fiscal needs to get to. There's a lot of things they can do before they really need to get down there. And one might argue they never need to get down there.
Right. Well, I guess they're feeling a sense of desperation, like many people are right now, when they're trying to figure out how to tackle this and throw everything at it. David, it's always good to see you. David Zervos is the Chief Market Strategist at Jefferies. It's good to get some time with you. Thank you so much.
Thanks for having me. Take care, guys.
And just to mention, as we continue to watch oil prices, they broke below $10 a barrel, WTI. I believe I saw a headline that they also had broken below $9 a barrel now. So we see this really incredible acceleration to the downside. We will continue to watch those prices, and we'll be right back.
Thanks, guys. Hang
You're watching Yahoo Finance Live. I'm Julie Hyman, and our Alexis Keenan had the chance to talk to the Attorney General of Washington because big tech has been sort of in the sights of many attorneys general around the country for different reasons. So, Alexis, what did the Attorney General there have to say about some of the tech giants?
So, Julie, this is about a lawsuit that the AG in Washington brought against Facebook. It's alleging that they violated state law on their laws that govern political advertising spending. And this is not the first time that Washington has brought this particular kind of lawsuit against Facebook. The claim that they're making that Facebook failed to make these certain disclosures that are required under Washington law that are really meant to put sunshine on who is paying for political ads. I talked with the state's Attorney General, Bob Ferguson. Take a listen to what he had to say about the possible fines that Facebook could be facing if they're again found in violation of the state's laws, as well as whether this problem could reach beyond just Washington state. Now, have you consulted with other state AGs to find out if this problem is more widespread than just within Washington state? Of course, we know that Facebook had a settlement it reached with the FTC, $5 billion in fines. Is this the sort of thing that could escalate into another large financial problem for the company?
I think that's possible. I would emphasize that every state law is different when it comes to what their campaign finance laws are. So what is illegal in Washington may not be illegal in another state. That's an important thing to point out. That said, I think it's fair to say that AGs, we speak about all sorts of issues all the time, especially high profile ones. I won't go into details about those conversations for obvious reasons, but I think it is more than fair to say that a number of AGs are watching carefully what's happening here in Washington state with these cases. And one thing I would also add is that anytime we're enforcing our campaign finance laws, our consumer protection laws, if someone is a repeat offender, we take that very seriously. And so the first go round of them settling for $240,000 should not necessarily be an indicator of what we think an appropriate resolution would be on this second go round that we're having with Facebook.
And it's fascinating that these conversations and these investigations are continuing even amidst the pandemic that we're experiencing. Alexis, I think Rick had a question that he wanted to chime in on for you. Rick?
Hey, Alexis, how political is this? Washington is a blue state and the Attorney General there is a Democrat. Is this just a Democratic thing, or is there some evidence both parties might be interested?
You know, right now, the Attorney General is saying that he's just focused on Washington and protecting his constituents. But look, you know, we saw Facebook get fined that $5 billion by the FTC for violating not the advertising laws, but consumer protection that stemmed out of those during the 2016 presidential race, after those political ads that ran on Facebook were found to have been generated by a Russian troll farm. So yes, Washington is a blue state, and yes, Ferguson is a Democrat, but there's also some research that's been ongoing by NYU over 2018 to 2019, looking again, taking a hard look at Facebook's ads. What they have found is that there are some inconsistencies in whether these ads follow Facebook's own rules that they've set forth, not only for themselves, but also that has been required by the FTC post Cambridge Analytica and the scandal that it was induced there. So, you know, we don't know yet, and certainly this lawsuit will take some time to get through the courts. But Ferguson, you heard him caution that Facebook should not be assuming that another settlement is in order as a second time allegedly offender.
Hey, Alexis, I just got to ask, you know, we talk about Facebook a lot when it comes to political advertising, where their responsibility lies. Did they mention anything about Facebook's involvement in political advertising in general, whether or not it should just step down entirely at a national level?
Well, you know, after the state of Washington reached a settlement in 2018, and that was for a span of 5 years of violations under that settlement. At the time, Facebook said, look, we're not going to run political ads at all in Washington state anymore, but evidenced by what the Attorney General's office is saying are offending 269 advertisements they say that they have found. They say that each of those offending ads is a $10,000 prospective fine per violation. That at a minimum would be, if all of them were proven up, would be $2.7 million, although the definition of what exactly is a per violation hasn't really been set forth by the state, by its Supreme Court. So there's a question there, but absolutely a good question.
Alexis Keenan, thank you so much for bringing us up to speed on that. And Facebook, by the way, those shares little changed in today's session. But as we take it a break, did want to remind you again of what is going on with oil prices today because of a storage problem and also the expiration of futures contracts. Oil prices are now down more than 50% in a single session. WTI is trading below $9 a barrel. Just an incredible move there in oil today. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. As school districts around the country try to get remote learning systems in place, many of them are scrambling, and many of them are turning to Khan Academy, which is a nonprofit free resource, even before this time, for people to learn remotely. Full disclosure, my fifth grader is on Khan Academy through his remote learning program in New York City schools. We're joined now by Sal Khan, who is the founder of Khan Academy. Sal, it's good to see you. Thank you so much. I'm sure that you are very busy right now with all that that is going on. One of the ongoing concerns and ongoing themes we have been talking about is accessibility of online remote learning, both from families that can't afford Wi-Fi, don't have computers, or folks who are in rural areas who don't have connections there. How do we go about trying to address some of that?
Yeah, what you're talking about is a central issue right now. I think there's always been a sense that the digital divide increases inequity. And the system has actually done a good job getting broadband and Wi-Fi to schools, but obviously we're in a situation now where home access matters. And frankly, it doesn't just matter for accessing Khan Academy or getting on a Google Meet with your friends or teachers, but also just to stay socially connected. And so what we're seeing is some school districts are doing a really good job of distributing laptop cards. You know, we work closely with Clark County, which is the fifth largest school district in America. It's Las Vegas. And they've done a really great job getting laptops out. They just ordered another round. Communications companies, for the most part, are opening up hotspot access.
I think we're having some connection.
And we're low-income high school students in the state.
Sal, are you back with us?
It's funny how we're talking about internet.
I think we're still having some let's try and work out these issues that we're having with Sal's connection, and turn it over to the panel here to talk a little bit more about this. Adam, as I mentioned, this is something that you and I have been talking about quite a bit. That a lot of education systems.
Can y'all hear me?
You see kids fall through the gaps.
Yeah, and one of the things that when we get Sal reconnected, one of the things they're doing is they've got learning plans, weekly learning programs. And I was curious whether if there was a way for somebody to download, you might not have good connectivity on Wi-Fi to be able to do the real-time learning lessons. But if you could download these learning plans, could people then help educate their kids at homes? Because we know from the beginning of the Trump administration, they were trying to bring broadband service to rural parts of the country, which absolutely did not have it.
Right. Or if it happened in patches, right? I want to turn it over to Dan Halley on another topic, and hopefully we can get back to Sal when we get him back. And that is the issue of contact tracing, so-called contact tracing, this idea that we can somehow map people who have come in contact with others who have been diagnosed with coronavirus. And we keep hearing more and more about mapping. I believe Facebook is now starting to do some mapping as well. Dan, tell us the latest.
Yeah, there's different types of contact tracing. Usually when you talk about something like this, you talk about people, boots on the ground, going door to door, talking to individuals who may have come into contact with someone who is infected, and then speaking to those who they've been in contact with as a means to tell them, look, hey, you should probably stay inside. You may have been in contact with someone who's infected. We want to stop the spread of this virus. If you're inside and you are infected, you won't be spreading it. Now, what tech companies are doing is taking their capabilities and enabling people in those kinds of situations, the tracers, to not necessarily have to have boots on the ground, but use different types of technologies to kind of track that. And what we're seeing is something similar. The founders of Instagram are giving us an idea of how the spread of the virus is trending through each state, and they're doing that through open public information about the spread of the virus. And then we have companies like Google and Apple coming together and working on their own initiative for contact tracing. However, we do have to point out our own Alexis Keenan, who was just on, had done a piece on this about how it could be a privacy problem if you're in a small town. These alerts, the way they come through from Google or Apple, is you get an update saying you've been in contact with someone who self-reported themselves as having symptoms or as being diagnosed with COVID-19. If you're in a small town, though, it would be a lot easier to figure out who those people might be around you. In a city, that wouldn't be the same.
Dan, they already do kind of contact tracing for other issues in cities and rural communities. So why is it such a stretch to think, I mean, these devices are already tracing us everywhere we go. The New York Times did a piece last year where it showed everybody in Manhattan and their movements. Now you could identify them. So isn't this a logical step to help fight the spread of a pandemic?
It is, but the thing is, people would have to opt in. I think the idea that your medical information is tied to it, they can anonymize the data. They do that. They ensure Google and Apple in their own practice say that they anonymize the data so much so that it's unable to be tracked back to an individual. In fact, what happens is your smartphone and my smartphone, if we sat next to each other, would basically trade Bluetooth identifiers. Those rotate every 15 minutes, so you wouldn't be able to get an idea of where I traveled, similar to what you're talking about, where people's GPS coordinates were able to be tracked on a map, and you could literally map people everywhere they walked. That the New York Times piece was incredible, showing that we're not using GPS here. Some countries are looking at using potential GPS data to track the virus. Other countries have already used the Bluetooth kind of method to great success. Singapore was one of them originally. That jumped on this, and Google and Apple actually spoke to them about it. But I think contact tracing with technology, people in the US still get kind of cringy when they think they might be being tracked. It's all kind of goes back to the big brother idea.
Yeah, it seems like that makes sense. Dan Halley, thank you so much. When we come back, we will be talking about the huge demand for behavioral health services right now, with a lot of folks stuck at home and very stressed about their economic or health plight. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. We have got Sal Khan back with us, the founder of Khan Academy. We have worked out some of our technological bugs. Sal, thank you for sticking with us. So I wanted to resume our discussion here about learning and education. If you resume and talk to us again about what you were saying.
Yeah, there's a deep irony for when talking about access issues that I clearly had some on my own side. What we were talking about is, for something like Khan Academy to be useful, and, we've been trying to put resources together for many years, never imagining this scenario. But as a baseline, folks need some type of device access and some type of internet access. And the system has done a good job over the last many years, making it accessible at schools. but obviously we're in a situation where it has to be accessible at homes. And a lot of school districts, you're talking about 20, 30, sometimes 40, 50% of the students don't have that access. And it's essential now, not just for accessing a Khan Academy, but also just for your mental health, to stay in touch with friends and family. And so we're seeing a lot of good actions by districts. Right now it's a little scattershot. We work very closely with Clark County, which is Las Vegas. They're fifth largest school district in America. They've done a great job distributing laptops. They've worked with the local telecom carrier to offer free internet at home. I know Comcast has a big program for free internet at home. So everyone's trying to do the right thing, but still early stages. All of it's happened so fast. Ray and Barbara Dalio in Connecticut have distributed 60,000 laptops to